you, Laura, and it's great to be here with all of you as always, and thank you for coming out on a Friday, right before the holidays. I'm sure you have a lot of alternative events and programs you could be attending, so I'm really happy you're joining us here today. As Laura said, I've been in EIR here for about 3 years. My career's been spent in the investment business, and more specifically working with early stage and growth stage companies. And I've been doing that since I got out of college, which was sometime back in the prehistoric era. So I've been doing this for kind of a long time. Got involved in the angel investing world, and we'll talk a little bit about that whole adventure in 2009, and ran an angel investor network called Hyde Park Angels up in Chicago for several years. Made about 15 personal investments in early stage technology companies during that time. At the moment, I am teaching in the entrepreneurship program at Kellogg. I teach both startup and growth stage experiential classes. And yes, I am a venture partner at Sarah Ventures, handling the Chicago market with our 3 main partners here in Champaign and 1 out on the West Coast. So having a lot of fun doing that. All right, we are going to talk about the market, some things you need to understand about the way investors look at businesses, and where there may be some things you need to work on or think about if in fact you decide you want to pursue investment capital as part of your business plan. And you don't need to do that, by the way, necessarily. You know, there are lots of ways to build a business. And we'll also talk about where there might be some opportunities for folks like you, because given what I heard going around the room, there are a lot of hard science folks here, correct? Raise your hand if you're hard science, versus digital software. Okay, and some of you are sort of a combination of both of those things. Okay, great. So, all these logos up here, what comes to mind when you see those? Money. Okay, a lot of them have something to do with money, not all of them. What else? Innovation, okay.
Mentorship.
Yeah, mentorship. There may be some mentorship involved in these. Success.
Right. Well, they visualize and connect you to a company.
Yeah, and these are all kind of logos that we kind of see. They're sort of part of popular culture now, especially if you're at all interested in technology, innovation, entrepreneurship. How long have these entities been around? How long?
About 5 years.
5 years? Other thoughts?
Hyde Park's been around for almost 10 now.
Almost 10, yep. I actually see EnterpriseWorks has been here since 2003, which actually means it predates all of these, right? Because all of these entities have been formed within the last 10 years-ish. I think Techstars actually started in 2006, but was really just pretty small for a few years after that, just got going. 1871, by the way, which is the big incubator in the merchandise mart in Chicago, opened its doors in 2012. So it's only been around for 5.5 years. So this is all evidence of sort of this explosion in entrepreneurship that's happened over the last 10 years. All right, so take a look at this chart. I don't know if it's visible from the back of the room, but this is global financing, venture capital financing, volume and value over the last 10 years, 2007 to 2017 by year. The line at the top is deal volume, number of rounds of financing during those years. And the bars are the dollars. So what do you notice looking at this?
Falling during an explosion of growth and interest.
That's a good point, right? So since 2014, which was kind of the peak, and you're looking at the top line, right? So the volume is falling.
You're doing half as many deals for only a little bit less than the total amount.
Okay, so the total dollar amount hasn't gone down all that much, right? But the number of deals has fallen quite a bit. What does that mean? Okay, so fewer companies are getting more money. And in fact, some companies are getting huge amounts of money. And what do we tend to call these?
Unicorns.
Unicorns. or sort of junior unicorns or whatever they are. So there has been tremendous interest in a relatively small amount of companies relative to what we saw a few years ago. This is early stage funding. Seed stage, angel, activity. Seed stage is the very first round of funding that companies will typically take in. Generally rounds of less than $2 million, sometimes as small as $500,000. From investors who are either angels, individuals, family offices, or seed stage funds. And what are we seeing here? Similar kind of a picture, right? Does this surprise anybody? Are you surprised?
Surprise is the right word, it's chagrined.
Chagrined? Why?
Because the number of people with ideas, I don't think is going down. So that means it's getting harder to get started when there's lots of ideas out there.
Okay, it means it's getting harder to raise money.
Yeah, right.
Okay, you can get started, but the raising the first round of capital has gotten harder. Is anyone here surprised though? Chagrined, I get. Does this seem right, given what you see in the marketplace? Because I'll tell you, a lot of VCs were shocked to see this. This came out right before Thanksgiving, actually. There was a blog post in TechCrunch that then kind of got picked up by a bunch of other folks, Brad Feld and Fred Wilson and a bunch of other investor and entrepreneur types that do blogs. It kind of circulated around as this surprising slump.
I mean, there's all this hype around
Yes.
startup activity, and we've got now half of the students are exposed to entrepreneurship, and you've got incubators exploding. There were 10,000 new co-working spaces that opened in 2016.
Yep.
So in the face of that, I think it's really complicated to say, why didn't all of it grow together?
Yes,
Huge volume of activity, but not necessarily resulting in meaningful investments. And, you know, like 1871 has had all these different startups, and yet very few of them have raised any real money.
well, I think that's a really good point. And because we all tend to focus on this dollar value, so that's the number that gets reported most. This trend towards fewer deals getting done has kind of been hidden. And a lot of people haven't been paying that much attention to it. But it's pretty interesting, especially if you're an early stage investor, to kind of see this. Now this chart, again, we're back to global, and I apologize, they're not exactly apples to apples, but you're picking up trends. Okay, this is again the global financing volume by stage of investment. So check this out, because back in 2007, this red line up here, which is early stage investing, the blue line, which is mid-stage investing, we'll call it Series A, for want of a better term, and the greenish line, which is later stage, which is kind of VC and all those other rounds. If you go back to 2007, there wasn't that much difference in the numbers being done at these different stages. But then what happened?
There was an explosion.
In what?
Startups.
In the startup investment phase, right? Look at the Series A and Series B lines. So they went up, but not by anywhere as much. So all this interest.
The bubble.
Well, maybe, but maybe there's some good reasons why this happened and why it's coming down. Pardon?
The true bubbles at first.
Okay, so why do we think things really accelerated between, let's call it 2009 and 2014? What was going on there?
Financial crisis.
Financial crisis, that had kind of happened before, and that definitely was impacting the 2008, 2009 numbers. That's why I'm kind of glad 7's in there, because 7 was kind of right before all that happened. But why this big explosion? What explains that? Other than hype, what explains it? Optimism.
Moving out of mainstream investment
Many more.
markets due to the
That's got a little bit to do with it, right? Especially low interest rates has kind of driven a lot of interest in alternatives. Keep in mind that a lot of this is digital. You're not going to answer, I'm not calling on you. Keep in mind that a lot of this is digital. Okay, what happened in terms of building software?
iPhone.
The iPhone, okay. What about the cost of building a software product? What happened? Dropped like a rock. And Rob was part of a team that built a software product in .com era-ish, right? And how much did did it cost to get your product from concept to MVP?
$10 million?
Okay, that's a little bit of money. How many undergrad entrepreneurs would think they're going to start a company that needs that kind of capital to get from here to there? Hardly anyone. Hardly anyone is willing to take that challenge on, right? Forbes did an article in 2012, so it's already 5 years old. They estimated the cost of getting a software company from concept to MVP in 2007 was $600,000. How much do you think it was in 2012 when they wrote the article? And they calculated it sort of in a line item way. How much by 2012?
50,000.
50,000. Okay, you read the article. Okay. Good for you. Smart plan. Yes, 50K. So it had gone from 600 to 50. What do we think's happened in the last 5 years? It's gone down even farther. And why? What's the biggest thing that happened in the world that changed?
Cloud.
The cloud. Okay, the cloud just cracked open the opportunity for folks to build a solution and get it to market. So that was huge. At the same time, there was this massive opportunity, again driven by the cloud, to disrupt legacy software players, right? The PeopleSofts of the world. We can look at almost any industry and kind of see the legacy players out there who were kind of old and clunky. And now with the cloud, we can deliver something elegant, easy to use, and just disrupt the heck out of them before they even know what's going on. So we saw that going on in B2B, and in B2C, we saw an explosion of mobile. Okay, apps. All of a sudden, we're all on our phones doing this, doing that. That cracked open the opportunity. And then you had the development of these sort of cloud-based tools, like Shopify. I can be in the e-commerce business in a day, and looking really good, by the way. I don't have to code all that stuff myself. So we had all of this going on at the same time, and this just drove this tremendous rush, mainly into digital, which resulted in this huge wave of interest on the entrepreneur side and also on the investment side. So I started investing in Hyde Park Angels at the end of 2009. And over the next few years, look what happened in a merry-go-round that was going faster and faster and faster. And at the same time, all of this stuff was taking off. When I first started at HPA, all of this stuff was really small, or it didn't exist, like 1871. All of a sudden, this is all taking off, which is generating the publicity, or maybe even hype. Bless you. So suddenly, everybody's an entrepreneur. So what about hard science? What do we think? Where does it fall in this?
Well, federal investment has been lagging inflation for a long time.
Okay, that's a kind of a long-term macro trend, right? But do you feel like it kind of got left behind a little bit with some of this stuff? Because I feel that way too. And there are a lot of funds that will only invest in digital models. Sarah actually invests in hard science models too, which is one of the reasons I joined, because I think there's a lot of opportunity there. And in fact, the last 3 deals I invested in at Hyde Park Angels were hardware deals, not software deals. Because to me, when I started seeing what was going on in kind of 2012, 2013, as it was spinning and spinning, I decided this is going way too fast. We can't tell good models from bad anymore. New angels are coming in all the time, flooding the market. This is kind of nuts. So I decided, after investing in a few hardware deals in 2013, I was going to stop. Then, of course, I found one more that I just love, that I kind of do. So I did that in 2014, then I was done. Does that surprise you? Given the numbers we saw on the previous page, it probably shouldn't surprise you, right? So what I say to entrepreneurs is raising the seed stage is important if that's your first step to building your company, or an important early step to building your company. But keep in mind, it's not the end. And since only 30% of companies that manage to do that are going to get to the next round, you really need to think ahead and make sure you understand what it's going to mean to get to that next round. Does that make sense? Okay, so if you're an investor and you're looking at these charts like a lot of people were a few weeks ago when they came out, what are you thinking? If you're an early stage investor, what are you thinking?
Like I might get it back.
What, okay, and this is a good question, right? Because a lot of people who invested during that peak are still waiting to harvest, including me. So we're still sitting there with these portfolios. We've got a lot of money out the door. We want to see what happens before we put any more out the door. That's part of the reason the brakes are getting put on. At the same time, there's a sense that it's getting harder to pull off a big disruption, because there have already been kind of winners anointed in a lot of these fairly obvious categories. Who wants to try to challenge Salesforce at this point? Be my guest. Right, so a lot of these categories have gotten kind of saturated, and we know who the winner is going to be. And in B2C, we find that a lot of kind of copycat companies are getting started. Do you want to be Blue Apron competing against HelloFresh, competing against Plated, competing against Me's Meals and Home Chef, and there are all of them, and how do they end up competing against each other? How do they compete? They can cut price, or they spend like heck on marketing. Wouldn't you love to know what their ad budgets look like? The one I always think about is ZipRecruiter. ZipRecruiter is on CNN like every 15 minutes. And they're basically the same thing as Indeed, and there's probably 20 of them that are the same thing. So then it becomes this wildly capital-intensive race. Oh, now it's cheap to build the platform, but acquiring the customers becomes insanely expensive, which is driving these big rounds and this unicorn thing, because everybody's trying to be the winner in these winner-take-all markets. So it's gotten a lot harder. And if I'm the investor and I see this and I'm on that red line, I want to make sure that my companies have a fighting chance of getting to the blue line and the green line and a successful exit. And you can see the bar is going to be a lot higher. So for those of us that invested into that kind of peaky thing, we are working our tails off right now to make sure that some of our companies are successful.
I'm sure you may get to this, but do you think the hardware and scientific-based companies who have perhaps fewer abilities to have copycats because they're very novel in the marketplace and have a lot of patents that have had decades behind it, they got to that point in a better or worse place in the face of this?
So my personal view, and chime in if you want to, is that I think now as investors we really have to be looking for defensibility in anything that we fund. There are lots of ideas that are good ideas, that clearly have value, that are clearly useful. The challenge is unless you can defend them, they're going to be competed against, and you're going to get into this capital bloodbath. And for angel investors, or for a fund like Sarah that's relatively small and investing in the early stage, I don't have the muscle. If you're in Andreessen, you can invest in whatever you want, because your ability to power it through is pretty strong. But if you're going to be more careful about it, you need to be very deliberate and look for something defensible, which is why I do think that companies that have solid IP, partnerships that somehow are tricky and can't be replicated, software that's got some deep technology built into it that is going to be really tough for somebody else to copy. I think those models have a lot of value. Whether other investors are going to start gravitating to that or not, I really can't say. I think they should. And I've been saying this for a long time in Chicago, that I think the hard science is where we all have to start looking. M-Hub, UI Labs, those kinds of places I think are very interesting because they're focusing more on those kinds of things. So I think that could be an opportunity for people in this room. You have a comment?
Yeah, I obviously totally agree. I think also if you overlay that chart with the number of venture capital firms are exploding too, and they tend to invest in the things that are easier to understand. So it takes a certain level of partner expertise or firm expertise to invest in hard science companies that I think a lot of the new capital doesn't have. So what that means is although there might be a large amount of capital available, the amount that's actually investing in hard sciences is smaller as well, which is going to make that capital harder to get for a hard science company. Plus you've got, we all compete on returns, and hard science projects tend to have longer return cycles potentially. It takes a lot longer to get to revenue.
Yeah, although I guess it would be an interesting analysis to sort of look at return potential relative to these other models, right? Because again, it's like this trade-off of it's cheap to do this but really expensive to do that. The digital piece, I think there is a sort of fallacy out there that they're easy to put together, therefore there's sort of this quick run and you make a lot of money in a year or two. Which, having invested in some of these, I have yet to actually see. Now it happens every once in a while, right? It does, so it's not like it never happens. But I think that's part of the reason that younger people and students, you know, my business school students at Kellogg, their ideas are going to put something together and have it, you know, going gangbusters by the time they graduate. You know, well, the chance of that is really small. I think with hard science, we've always been a little more realistic about that. It's going to take a while to get there. But it does, and you end up grinding it out. So, any questions? Does that make you feel better or worse?
Much better.
Makes you feel better. Does anybody feel worse?
Second that motion.
Is there any sort of ratios about like the amount of money that gets spent against digital software that's B2C, that specifically as an example of
Yeah.
how much has to be spent in customer acquisition, marketing costs, and how that might compare to you've got time and money going into, say, a hard sciences capital intensive.
So I've never seen that, but that's what I'm saying is I would really like to see it. The problem with any of this is you can only tell over time, right, when it's over, because you're kind of looking back to see how returns shook it out, which is a problem with any of these kinds of analyses is that, you know, there's a lot that's out there that we don't really know what, you know, where it's going to shake out.
Actually, this is just a comment. Like, I think for hard sciences, yeah, there's a longer lag phase. But if the support comes like at the early stage, the returns are much larger. Like if the proper
Potentially.
support comes.
So one of the other issues with hard science, and this goes back to the tough love piece, is that most of the time digital starts with a customer and a perceived problem, and then they're building a product around it. Hard science often starts with a technical development that turns into a technology that then we're trying to turn into a product and find a market for, which is sort of the backwards way of looking at it. The challenge with that is that you have to understand the business potential of the idea, not just its technological potential. And this is a challenge for us as investors because we invest in businesses, right? So we can't create your model for you. I mean, we could, but you probably wouldn't want us to, because we're not going to pay enough attention. We can't create that business. So we're looking for you to understand the business potential and how you get from here to there. All right, and we're going to talk a little bit more about that here. All right, so early stage investors are kind of scared at this point, right? They're trying to make money off their old deals. They understand now a little bit more about how tough it's going to be to get the new deals pushed down the line. And so they're being more careful and looking more at things like defensibility, strength of teams. All right, what does this mean for aspiring entrepreneurs? Okay, the bar's gotten higher. There's no doubt about that. Whether there's a better opportunity for hard science or not, the bar has gotten higher. We're going to look a lot more carefully. And the days of companies coming to Hyde Park Angel and having everybody go, hooray, and just write a check is probably, if not done, it's definitely on the decline. Okay, you're going to have to prove out that you've got something more. Valuations, well, we hope the investors hope they're coming down. We haven't actually seen this yet in our market, though our friends on the coast are telling us that they're starting to see that. So maybe that's the case. That is not necessarily a bad thing from an entrepreneur's perspective. But what it does mean, and you know what a valuation is. Do people know what it is? Do you want me to tell you? Okay, this is the price that an investor puts on your company before they invest in it. So, you know, it used to be sort of 2 or 3 million was a decent price for a seed stage round, even lower back in the recession. One of my Hyde Park Angels deals went in at $1.5 million pre, and that's going to be a big winner. We've got nice paper gains in that deal. But, you know, he wanted to get the business started. It was 2009. That's what you had to do. But they started to go up, and we're seeing notes without caps and a lot of expectations. And I think that those days, hopefully, are starting to taper off. Because the entrepreneurs need to be realistic, too. You set yourself up for a lot of pain if you price your deal too high, even if you can actually get it funded. So we all want to be kind of careful that we have our eyes open going in. This is where I think I-Corps is helpful, right? Because it gets you out of the building and starting to talk to people. The challenge with that is, especially in the Midwest, because we're all really nice and we're all curious and want to be encouraging, a lot of people will say this is a great idea. But the only time that really counts is when they're willing to hand you their credit card or write you a check. Okay, so take a lot of that stuff with a grain of salt. And what you want is the critical feedback, not the, wow, this is great, which is what you hear from a lot of people. So be careful about that. And then you need to figure out how you're going to connect with these people. Are you going to sell yourself? Are you going to go directly to them? Are you going to find them somehow online? Do you go to a trade show and find them? Do you work through a partner to find them? If so, is the partner excited about what you have to offer? And how will all of that play out? The farther you can get down the road to explaining this, all of these little essential elements to a business model to someone like me, the more likely I am to advocate for funding you. Because the more I know that you've thought this through, even though things are going to change, they will definitely change. Why will your solution be a priority for the customers? I was talking to Larissa, she's not here now, but we were just talking about this, and she was saying, some of the things she's seeing, they are really nice, but you can't get anybody to buy them. Okay, because they're great, they're just not my priority. It's got to sell something that I think about a lot for me to go ahead and do it. What do your unit economics look like? I did a whole talk on this, I don't know, a year ago. Unit economics. How much are the customers going to pay you? How much can you make from them? How much is it going to cost you to go out there and get them to be your customers? You need to kind of think that through. Because it, again, starts to inform how much capital you're going to need to get the thing rolled out. Who are your competitors? You would be surprised how many companies can't address who their competitors are. And it's not just people offering the exact same product. It's all the other things that your current target customers are doing to solve that pain point. Which may not even look like what you do. Is your team qualified to build out not only the product, but the business? And if you're not, if you believe that the business skills are something you need to find, be very upfront about that. Where are you going to find that person? I would start talking with business people as soon as you can. Throw your model out there, kind of test what they have to say about it. Start thinking about things in a business context, and maybe you'll get some clues that way. And then how are investors going to make money on the business? Who's going to buy it? Why would they want to buy it? So how are you going to find all these things out? Okay, it's like ICOR on steroids, kind of, right? I would encourage you to look at analog companies. What is an analog company? Versus a digital company. It's not. It's not. I know scientists people are like, what? What? What's an analog company?
Like a brick and mortar?
That's a good thought. It's a company that's kind of like yours, in some way. Right? So if it's e-commerce, you look at another e-commerce. If you're selling a B2B solution to the, whatever industry, it's something else that sells to them. So you want to kind of take a look at them to the extent you can. If they're not directly competitive, you would be surprised at how people will sit down and talk to you. Especially if they think there might be something complementary or in it for them. If there are public analogs, you can start looking at, their public data. You can find out things like how much is it costing them to acquire a customer. Sometimes they disclose that stuff. What do their margins look like? How much are they spending on product development? You can kind of get a feel for those sorts of things. Because you need to be realistic when you come up with your own assumptions. Who's buying companies in your industry? How much are they paying? Why did they buy them? What holes do they have in their own portfolios that they might be trying to fill? And if you're addressing that, that's kind of a good thing. Accelerator programs can be helpful. If they're good ones, right? And there are lots of accelerator programs because, like going back to the beginning, these things started springing up like, weeds all over the place. So some are really good, others are, maybe not. But the good ones are pulling in mentors from places like the big companies in your industry. And they force you to talk to people. Some of them have this month where all you do is meet with people, which is exhausting. And there are lots of dry holes because a lot of these meetings are going to end up going nowhere. But you can learn an awful lot in the process. And so the idea is you're just sucking in all of these insights. Not that you believe everything you hear, or that you take everything to heart, but you're sucking it all in and then generating your own analysis after that. If you're gonna need to raise more money, and most models do, you better know what the Series A investors need to see to write that check. And you better be pretty sure you can get there with the capital that you're raising today. So Series A in software, they want to see $1 million in annual recurring revenue. So how am I going to get there? A friend of mine's on the board of a company that's got a mobile app that has an ad-supported revenue model. Okay, so to attract national advertisers, you need to have 2 million users. That's a lot of users. If it's costing you $2 to acquire each user, that's $4 million just in customer acquisition to start to generate significant revenue. So when you start to hear details like that about the way other companies work, you can kind of start to roll out what that might mean in your business. And then judge for yourself whether that makes sense to go forward, and make sure you're properly resourced if you want to do it. All right, you want to get to know bigger industry players. We've already talked about that. What is it they want? Can you partner with them? Are there opportunities there? Is there something exciting about what you're doing? When you have meetings with them, or do they get all excited, or does at least one of the guys get all excited about what you have to offer? Find a business-oriented co-founder. This we've talked about. It's not super easy because this co-founder relationship is very delicate. So it'd be nice to say, oh yeah, we just do it. And technology management, I don't know what that is, but you guys may be kind of working towards being this person. Is that right? Kind of?
Yeah, a little bit. It's
After your
like,
product manager at Facebook for a while?
yeah, it's like a lot of the jobs kind of like technical account managers or
Okay.
technology consultants, something like that.
Okay. And bigger companies to start with, but you may be able to work your way into doing this. The execution skills are huge. Advisory boards can help in the early days. Again, make sure you get people who are going to give you honest, critical feedback, because if it's just people who are going to encourage you, that's nice, but you've got your family for that, so you don't need that on your advisory board. Okay? You need to be tough. All right, so things investors want you to know. Do you have a question?
Yes, so how do you typical startup company assemble an advisory board? Is this through something or?
Well, sometimes, so if you're part of an accelerator program that's going to introduce you to people, I would meet a lot of people before I decide who I'm going to put on my advisory board, who I'm going to ask. Because you want to make sure you're picking the right people. You don't want to cast at thousands. So you want to make sure that you're going to get somebody who is knowledgeable in your space. And that could be either from a product perspective or I would suggest from a market perspective is probably more important. You want to get someone who's going to be committed to paying attention. That's harder than you think, because people are really busy. And you have to get someone who's going to be willing to give you critical feedback and hopefully open some doors for you to others, whether that's money or partners or customers. That's the kind of person that I'm really looking for.
Can you scoot back to the other slide for 1 second?
What?
Scoot back to the
Oh.
other slide.
That one?
Yeah, you got fast.
Okay. You can have the deck too later.
Oh, okay.
I don't want to block the shot or anything like that. Okay, so things investors want you to know. You need to be fully committed to making the business a success. So how many people in here are full-time with their companies? Okay, so that's important. Because this can't be a side project if you want investors to write checks into it. Investors don't want you to have a lot of options other than making the company successful. This is really hard for my Kellogg students to swallow because they'll say, well, if I get investment, I'll work on it. If I don't get investment, I'll take the McKinsey offer. And I tell them, okay, I will never write a check to you. Because I know that when the going gets tough, you're out to McKinsey. And I get it that you have options. Everybody in this room has a lot of options because you're all really, really smart. So I get that. But I want to make sure that in your head, the only option you have is making this thing successful because it is going to get really hard. And this was actually a big topic among early stage investors because there are you know, a lot of entrepreneurs, right, because it's sexy, it's cool, we have a good idea, we're smart. Seed stage money is kind of easy to get a few years ago, who got into this, and then when it became hard, and they couldn't raise Series A, they just sort of said, oh, well, there's no more money. I was on the board of a company like this. This was one of the worst afternoons of my life, because they said, well, we're pulling the plug, because we're running out of money. That's not the answer. The answer is, here's plan B, here's plan C. Here's how I'm going to cut expenses until I can pull more resources in here. Here's what I do. And they actually looked at me and said, well, you've been an investor for a long time. How do you know when it's time to shut it down? And I said, when there are no customers. That's when you shut it down. And that happens, right? We get a technology out there, nobody wants it, it's too early for the market. That stuff happens. But to me, to give up because you couldn't get, you know, Joe Blow, the cool investor, to write a check, that's not going to happen. There's always a plan B and a plan C. This is why you have to love business, because you have to be constantly thinking about, what do I do next if this thing doesn't work? You guys who are full-time, do you agree with this, or do you have other thoughts?
We're already on plan 1C. Okay.
Yeah. How about you?
Actually, I would have quit probably 9 times if I had a backup plan, so.
Right.
It's not been easy, so you just grind in and you make it work.
Right? Yep, you figure it out. Figure it out. Investors fund businesses, not research projects. I think we've talked about this. Okay, so you got to translate it into something I can understand, because I'm not a technology person. I'm going to assume that it works, by the way, because this is, I consider my non-technical background a big strength as an investor. So I got to assume it works, and I'm thinking about the customers, and then, you know, we'll figure out, somebody else will figure out whether it doesn't work. All right, building business is a long-term project. There was a recent study of angel group returns over, I don't know, 10-year period, I guess. And the average hold time for an investment that exited was 4.5 years. But keep in mind that included a lot of stuff that was sold off early because it wasn't going anywhere. The average length of time for the hits, the home runs in these portfolios was 9 or 10 years. I told Jim this, he's like, oh my God, 5 more years. But it takes a while for the thing to really go. So this idea that we're going to be rich in a couple years, forget that. If that's the reason you're starting a business, you're going to be really disappointed. It could happen, but don't bet the farm on it. When you take investors' money, you made a serious, serious commitment. Okay, and I am a really nice person, but if you're doing a lot of personal things and telling me about work-life balance, I don't want to hear that stuff. If it's my money, I don't. I don't. And that sounds mean. I had a CEO once tell me he needed a raise because his wife had decided not to go back to work after their third child was born. And I said, not with my money. I mean, if she doesn't want to, that's great, that's a great choice, but I'm not funding it. Sounds kind of nasty, but you got my money, you need to make this work. Now, the guy I told you about before, who was 28, now he's 35, because he stuck it out, and even though, and we were literally looking for quarters under the seat cushions when the sale deal closed, he made money for his investors. Not a lot, but I will always remember how he hustled at the end to get this deal done so that we made a little bit of a return. So that when he comes back the next time around, I know that he's a good steward of my capital. Okay, this could be a whole topic in and of itself. You've got to be prepared to share control if you're bringing investor money in. It's not just your baby anymore. Kind of goes to the point before. Yeah, that's my next workshop. Do you want to be rich or do you want to be king? Has anybody read Noam Wasserman, Founder's Dilemma? Okay, so that's one of the questions he asked. If you want to be king, bootstrap it. If you want to be rich, you might think about taking some money in. And understand that there may come a point where you're not the founder anymore. You may need to step aside.
Maybe be a goal.
Pardon? That may be a goal, okay. Yeah, I want to get out of here. Yeah. I mean, you're still the founder.
Yeah.
You're always the founder. But you may not be the person that runs it. We go through this with portfolio companies all the time. Because at a certain point, that vision and excitement that the founder brings to the party has to be replaced by execution skills. Someone who knows how to crisply get out there and execute the business pieces of it to make the return really work. And that can be okay because done well, we all make a lot of money that way. And most founders really don't want to do that anyway. We'll take it to a certain level and then they'll decide. It is a different set of skills. Okay, the timing is working here. So finally, figure out what it is you want, what your goals are. And don't get all caught up in the hype of way back when. All this stuff. Because this is like reality TV, right? Some of these are a means to an end, but don't let that drive what you want to be. You drive what you want to be. Any last questions? Yeah.
So in our business, we face certain competitions, right? One thing we kind of worry about is these competitors raise big money and
Yeah.
they crash.
Yes.
And how does the market respond to this kind of crash? If they become unicorn and they run out of money at one day and without any meaningful return, would the investor be looking at the next company who may make it work, or just gonna ditch them?
So you're afraid your company, by the way, please leave if you need to, because I know people have other things to do. You're concerned that your company might have a harder time getting funded because of, that can happen. Okay, I would be lying to you if I told you that couldn't happen. You have to show why you're different. And it's really tricky. So I was involved with a company that we were very focused on operational efficiency and a unit economic model that made sense. We were very honed in on that to the point where we overinvested in it at an early stage. And what ended up happening was that we were growing and our model was working, but we weren't growing really fast. And there were some other companies in our industry that raised money, kind of a lot of money. They were growing super fast. Their operations were a complete disaster and they were bleeding cash. But it turned out, one, the venture guys wanted to see this hockey stick growth and we weren't showing that, so that was problem number one. Problem number two is that when they started bleeding out, and several of them were sort of forced to shut down or fire sale, like you're saying, then people said the model doesn't work. And we had a really tough time then trying to go to them and say, well, no, ours does work. So that was a challenge. Now, what didn't happen, unfortunately, because we ended up selling it, but what should have happened is that we were able to attract enough capital, not trying to raise a lot, not going to Andreessen Horowitz and these other big names, but finding enough sort of angel type money that we could get to break even. And at that point, kind of just keep growing sustainably. And when all those others crashed, then we're the last ones there. And at that point, we could have blown out the model. That was what we were trying to shoot for. But again, that's going to take time.
From that point, how many investors would still listen to you, have the patience to really understand the model?
People were listening. People were listening. This is the one where the entrepreneur wanted to sell. You know, shut it down or sell, whatever. And that was hugely disappointing to me because I still believe we had a good opportunity to make it all work.
So is that an example of what you were saying earlier about doing analog research? And if you do that constantly and continuously, you can compare yourself to what's going on with other folks.
Yeah.
And you can maybe get out ahead of that and say, hey, they're about to crash, you need to look at us.
Well, it's hard to say that.
Well, but you know what I mean.
But we did attract a group that knew that those models were headed for trouble. Because they were so overhyped and you could see how much they were spending relative to the revenue growth they were getting. Mm-hmm. And we were getting customers off of that too, because their customer service was terrible. Mm-hmm. They were just growing too fast. Mm-hmm. So we were benefiting from it, mm-hmm. though ultimately we weren't successful at making the case. But I think we very much could have. Where we were finding a welcome or a receptive audience, truthfully, was not with VCs, it was with industry partners. Mm-hmm. And this was in e-commerce. And we were finding brick and mortar partners who were seeing all the growth in the sector and thinking, man, I need to have some kind of play in the sector. But one, they couldn't get into those companies because their valuations were so high at that point that you're not going to spend $500 million to do this. Whereas you could have invested $3 with us and had a toehold that you could much better control. So we were getting a good audience. It's just they're slow. They were slow. Yeah.
Recently we see a lot of big companies are reluctant to go public, like Uber, Airbnb,
right.
and keep sucking out the
yes.
private funds.
Yes.
Yeah. So how does that affect the smaller startups? And I think maybe some of the changes that we've been seeing is that those bigger companies are raising $1 billion
yes.
financing rounds. So how does that affect the smaller companies that raise funding? And is there not a very dynamic size for the public versus private funding.
Well, I think they're different investors that are investing in the, Ubers now, well, they are, versus seed stage. So these aren't the same markets, so you're not competing against them directly, right? It will be very interesting to see what happens to these companies ultimately, because we don't really know what's going on under there. And I know there are some people betting that Uber blows up. Because they've raised, I looked it up the other day, $11.5 billion. And they're still not making money.
All the sea levels.
Yeah, so you wonder, like, what is the game plan with that? Because eventually they have to turn this into, something that makes sense from a cash flow perspective. And I think that's partly the reason they're doing all of this, driverless car and these other technologies, because they were an app. It was just an app.
Do you know Magically?
Mm-mm.
They're over $1 billion. They make kind of like augmented reality.
Oh, yeah.
They don't even have a customer yet. Uber at least has customers.
It's true, they do have customers. They do have customers. I mean, I don't know, one of my favorite whipping boys of last spring was Blue Apron. Partly because most people in the audience, understand that model. A lot of people are probably customers, they're probably customers of Blue Apron here. And, we were talking a lot about it, and at the time we didn't know what its numbers were because it hadn't done the public offering yet, but you could kind of parse them a little bit and see that this was a very difficult model to make money on, mainly because the churn is really high, right? So their margins are pretty good, they are acquiring new customers, that was okay, but they can't hold on to people, and why is that?
It's just a novelty.
Partly it's a novelty, and partly what else? Is HelloFresh has this whole gang of kids out on the corner, like shoving coupons in your face. So people are shutting up. So they're having to reacquire the same customers over and over. Because you get that coupon, you go to HelloFresh, then the Blue Apron comes, you go back to them, and da-da-da. So as consumers, this is fun, because we're getting free food and it's all great. But from a business model standpoint, it's very tough. So I don't know if you follow this, but they did their public offering last summer. They were supposed to go out at $15 to $17 a share was the price that was being floated out. By the time they got it done, it was $10 a share. And their prior private round had been at $2 billion, right? That was the price the last private guys in had paid. They went out at $10 billion or $10 a share, which kind of made them even the $2 billion. So at that point, the last guys aren't making any money. The first guys still are, right? But the last guys aren't making any money. But the numbers started to show it's getting harder and harder for them to grow, right? And I believe the market for that food kit stuff is only so big, and everybody's just fighting over share. There's not real growth happening in it anymore. And so their marketing costs as a percentage were going, it's like they were chugging harder and harder to get that next piece up the hill. And so the stock price now, does anybody know what it is? So it went out of 10, that was in the summer, like June maybe, it's down to 3. So it's been a disaster. CEO's been fired, lawsuits out there, all of these things. Could they have seen that coming? To your point, probably. That's probably why they did it. Because they're all desperately trying to get out of there, pawn it off on the general public, like we all did at .com, and get your money out. They probably didn't make it because it fell really fast. So, I always tell people, don't get worked up about the hype or look over your shoulder at what this one or that one are doing. You only really know about yourself. Look at the business models for sure, but don't get freaked out because this guy raised $100 million at some astronomical valuation. Because there's a pretty strong chance they're not going to be able to live up to that. Whether they crash and burn or whether the value just goes down. So, yeah.
You say that 70% of seed places don't get Series A, and then you sold off the thing. Who's buying stuff if you don't get Series A?
So what's happening to them?
What does that mean for the guy? Is the company still a thing and it's just owned by some other thing now?
So there are several possibilities. Okay, one possibility is it didn't need more money. It got to break even, it's still growing, it's doing its thing. That's probably a low likelihood for the companies that are being tracked in these kinds of data. The other likelihood is that it got sold. That happens a lot. Whether any money was made is a different question than whether it got sold. So one of the things you should know is when you see articles in Cranes about company X, it's acquired by unless there's a price disclosed in there, I'm always very suspicious that nobody made any dough. Partly because mine have been in there and I know we've lost money, which makes you really sick when you're taking your ride off and this article shows up and there's your CEO, oh, we're so excited to be part of this, and you're getting calls and people are congratulating you, just like, oh my God, this is like a nightmare, just make this end. So a lot of times that's happening. You're getting part of your money back, maybe. You're finding a landing place for your team. An acqui-hire, that happens sometimes. You might be making a little bit of money. You might be making a lot. Usually when they're making a lot, the numbers disclose. Clever Safe sells for $1 billion too.
Right.
You
So
know,
potentially
obviously,
that company still exists as some entity.
It might.
Didn't continue.
It might, or it might have died. It
Is
might
there
have just shut
other
down.
statistics on what percent that did seed money just completely collapsed to nothing?
Yeah, so I was going to look that up. I thought it was sort of throwing too much data at you. So I'm going to try to do this from memory. There is information about companies that raise seed that go on to A, that raise A that go on to B, B that go on to C, and then that exit. And it's something like 14%, something like that. And it's unclear how many of those made a lot of money. In this angel study, this angel group study, that's kind of an interesting one. I'm going to try to remember this. Out of a 10-company portfolio, the return was around 2x, so 2 times your money back over 10 years. And 75% of all the capital returned came from one deal. So the majority of deals, so like half the deals are write-offs, then there's another group that's sort of break-even-ish, and then there's one that carries the day. Which is why you have to have a portfolio if you're going to be an angel investor. Don't just do one deal, because the chances of it being that one are pretty low. And the second piece to that is that, sorry, some piece to that. Anyway, so you have to have a
We talk to
portfolio.
our startups, sometimes we'll say, keep that in mind, that it's only 1 in 10 is gonna work out. So that's why it's gonna get priced, and the return expectations
Absolutely.
will be what they are, because, at least 5 are gonna be a goose egg, and you might be one of them, and you don't know that, and they don't know that necessarily.
That's right.
So they gotta make a big bang on at least one, and if you're the one that gets to be the winner, you may feel like you got a little bit screwed in that, but you also had the chance.
Right.
And no one had the others.
You got the piece of the pie and grew the pie. So I remember what I was going to say. If you're interested, there's an article, TechCrunch blog post that came out probably about 1.5 years ago now, called "Venture Capital is a Hell of a Drug," and it's cautioning founders against taking venture money unless you really know how it's going to be put to work and generate a return. Right? So you're really looking to put rocket fuel onto something that's working. Not raising capital to flail around and figure it out. Because that is very expensive. And you're giving up a lot for that. So you're giving up a lot of optionality to sell your business at prices that are more reasonable, right? So the highest probability, if your business is successful, that it'll sell for $50 million or less. Right? So, because a lot of companies are sold for $50 million. The probability of your company being acquired for $1 billion is super small, because how many companies can afford to write $1 billion check? Like hardly any. These unicorns, they're shooting for an IPO, because unless they IPO, they're not going to make the return, because the chances of being sold for $1 billion are very small. But once you take the money, the venture guys have to push for a bigger and bigger exit, especially if the valuations are high. Now suddenly, you got to exit for $100 million. You got to exit for $500 million. You got to be $1 billion company, or it's no good to me, because I need for you to be that one that's generating my home run. I need for you to return my fund. If I'm a $300 million fund, I need for you to return $300 million to me, and I'm probably going to own maybe 20% of the business. So how big does that business have to be? Exactly. So I'm going to push you to shoot for the moon, because if it doesn't work, I still have 20 other companies that I can go for. You don't. You're screwed up. So if you take that money, they're going to push you to jack up your burn rate and go for broke. And if a deal comes in to sell for $100 million, not happening. Because we need for you to be a lot bigger than that. So you got to keep going. You got to keep trying to make this work.
So that's been interesting sometimes, the tension between angels in a deal for some of our
Yes.
companies. When there were angels in, there's a VC in. The VC wants it to be a big deal, the angel kind of wants them to keep their burn rate low and would be okay with a lower value exit because they get their money back.
They pay less,
faster
well, they pay
when
less.
Yeah.
Yeah,
So how do you kind of coach the entrepreneur, having been on the angel side and the VC side, and what to do?
so the problem is you don't know what the situation's gonna be until you have it, okay? So it's hard to anticipate it in advance. But I've been in this situation, first of all, you ought to always keep in mind what they call the waterfall, which is your cap table at the different rounds. Because the different rounds go on top of each other. We're getting way in the weeds. Okay, so you're going to be the common shareholders. The next guy in is above you. The next guy is above him. The next guy in. The different layers get their money back before the others get to share. So it creates some really weird places in the cap table where if the price is below a certain amount, the top guy's going to get his money back, the rest of us get nothing. If it's between X and Y, we're happier because we paid less. He's not, because all he's going to get is his money back. And there's the great scenario where it's worth a lot and we're all copacetic. But where things get weird is in this in-between place where you start to argue. We had that with one of our companies a couple of years ago where there was a debate about should we sell it. And the likelihood at that point was that if we sold it, the top group would get their money back, the rest of us would get nothing. We felt if we held on for a year, we could sell it for enough that they weren't happy, but we made a lot of money. So and then the founders are at the very end. So, they're sort of the kind of tail wagging the dog, because unless you have them on board, you can't sell the business. So it becomes kind of a hairy scenario and something to keep in mind when you're raising money, that this kind of thing can happen. What you really want is a strong independent voice on the board. Because generally the boards end up half founders, half investors, who may all hate each other now because they're in different places. You want an independent who may end up having to be the tiebreaker in this. So you want someone really smart and really good who can be objective and kind of put the collective interest front and center. So now you're really scared. Nobody wants to take venture money at this point. Yeah.
There's one thing I wonder about, I don't know, I really haven't found the right answer to this question yet, but so if I go out and sell, if I'm trying to sell something, I'm going to try to identify my customer's pain, and I'm going to try to customize the way that I speak to them to speak to their pain. In the same way with a strategic investor, they're going to have more than just the bottom line. They're more than just financial gain. Like I was pitching a company to whom time to market is what matters.
Yeah.
To them. So I identify that, and I really want to pitch. Okay, we're an agile team, we're a scrappy team. We can, accelerate your time to market. With a venture capitalist, it's easy to kind of look at what's his money, right? I'm just looking purely for a financial return. But how much, is there an element of just kind of doing your homework on what deals they've gotten burned on, what deals they've made money on, and really trying to spin your story or sell your story, with that frame of reference, or?
So when it comes to your approach to the way you're selling, you have to decide that and make your case for it. So what we don't want, this is kind of a weird issue too. When I was running Hyde Park Angels, there was a lot of conversation about coachability, right? We love to have these coachable CEOs. And what we meant was we want CEOs who will listen. You don't want someone who just flat out refuses to listen, just doesn't want to take anything into account. But what it starts to mean sometimes in an angel context is we want somebody that we're going to mentor, especially if they're younger. And this is because, something to look out for, a lot of these guys do this for ego reasons. They want to be your teacher, even though they may not be the best teacher. They liked this, being like, do this, I'm mentoring, judgment. So then that became, okay, well if the CEO is so malleable that they're looking to the investor to give them the answers to things, I don't want that guy. This is why I want someone who's more mature, who's going to be able to kind of push back and go, no, we thought about all these things. Here's how we analyzed it. I don't want to have to create the business model for him. So there's a spectrum, and what coachability means to different people, I've sort of come to think, yeah, you better really understand what's going on with that. So we want you to have your own opinions, backed up by data to the extent you can, about why these things make sense. But when it comes to sensitivities around certain types of investments, definitely, the more you know, the better off you are. If you can talk to some of their portfolio company CEOs, that's probably the best thing. You know, what are these guys like? What are they investing? Because if they've gotten burned in certain segments or by certain things happening, yeah, they're going to be overly sensitive to that the next time around. And we have to be careful because it creates a bias. So if you invested in something 10 years ago and it was too early for the market, you know, and now it's coming back around in another company, and you turn it down, well, maybe the market's here now. So things change. So you can't just say, well, never, never, never. But it does sort of create some biases that you may have to kind of work your way through, or be cognizant of as you're making the presentation. Yep.
I feel there's sometimes a competition when the market start being crowded, big capital. So companies try to fight for capital.
Yes.
So,
But we fight for good deals too.
right.
I just sent brownies to a team this morning. I really wanted to keep
So
them all.
they raise money, not necessarily think they need money. They're just trying to be the bigger guy in the game.
Well, don't do that, because if you can't use that capital productively, what did you do that for? You just took dilution, right? You sold part of your business. The only reason you want to sell part of your business is if you can take that capital and make the part you still own worth a whole lot more.
But what we see in the market is a lot of people do this.
Well, don't do it.
No, we don't do it.
Did your mother ever tell you if everyone jumped out of the building, would you do it? I mean, come on. You're at the University of Illinois. We don't do that. Let the California people do that.
Parting words would be, if you want more time with Karin, sign up for her as an
Sign
EIR. You can request your time online, either here in person or remotely. Thank you, Karin.
Thank you.
Thank you.